Northern Illinois University, you may begin.
Founded in 1928, Motorola is a public safety communications equipment industry giant that pioneered car radios and cellular phones. Headed by CEO Greg Brown since the company's 2011 split, Motorola provides land mobile radio networks, video security and analytics, and command center software to governments and commercial customers. Motorola leads its peers in terms of ESG transparency. Its environmental policy focuses on waste reduction, climate impact, and supplier practices that mitigate mineral mining consequences, yet could be improved by disclosing its renewable energy utilization. The positive industry recognition for its social programs focuses on its launch of DEI and data protection C suite officers, its pandemic driven measures to protect its workforce, and its foundation support of fallen first responder dependents. However, controversy surrounds its West Bank ground surveillance provided to Israel. Governance is Motorola's weakest area. Despite its institutional oversight and one share, one vote structure, its CEO compensation is excessive relative to peers, and its dual CEO board chair appointment introduces agency problems. While no one company competes in all of Motorola's technologies, its main competitors in each include L3 Harrison Land Mobile Radio, Axon Enterprise in video security and analytics, and Tyler Technologies and Command Center software. Industry tailwinds displayed on the left include federal, state, and local public safety spending, corporate IT expenditures, and cybersecurity attacks. Our buy recommendation is driven by three main factors: Motorola's land mobile radio economic moat, its high growth adjacency acquisitions, and its expanding margins. Motorola's land mobile radio domestic and global market dominance creates a moat, which, according to our survey of 1,000 first responders, is supported by high switching costs from sunk infrastructure investments and sticky long term contracts. Motorola then boosts revenue by upselling to captured customers, such as the 6% of additional revenue generated in Q1 by its groundbreaking Apex Next radio. Motorola also cross-sells its other technologies to captive customers. It has hastened its penetration into these less protected, faster-growing video security and analytics and command center software markets via acquisitions at a rate that exceeds its technology peer groups and closest competitors. Motorola's service-heavy adjacency acquisitions have also improved operating margins by 290 basis points over the last 6 years. We expect that future adjacency acquisitions will result in software and services accounting for half of overall revenue by 2030, driving overall gross margin up to 57%.
Next, we will discuss current and forward-looking financial metrics. To project revenues through 2031, we separately regress products and systems and software service revenues on historic drivers, a subset of which can be seen at the right. Then, we pair significant coefficients with driver forecasts. We then integrate the assumption that acquisitions will focus on service targets within the video and command center technologies. Consequently, we expect that overall sales growth will stabilize at 3.9% annually and that gross profit margins will improve by 8.4% throughout the forecast period. Using management disclosed targets, we prioritize cash flow allocation. Specifically, we expect Motorola will spend 20% of operating cash flows towards capital expenditures. Similarly, to fund software service acquisitions, we assume Motorola will spend 37.5% of operating cash flows. Motorola has paid and increased dividends nearly continuously. We assume that they'll honor this commitment with 30% of operating cash flows. We also expect that they'll return wealth via repurchases, doing so with 12.5% of operating cash flows. Motorola's heavy debt load has led to a relatively excessive debt-to-EBITDA ratio, lower credit rating, and outlook. Despite the bankruptcy potential suggested by its Altman Z-score, their default probability is less than peer averages. All of Motorola's current debt obligations are fixed, alleviating interest rate risks. Additionally, their newly increased $2.37 billion revolver acts as a floating source of liquidity. Our valuation is based off a free cash flow to the firm discounted cash flow model. We arrive at our $258 12-month target price by growing the 2031 FCFF perpetually, then discounting all cash flows at the firm's WACC. The terminal growth rate is based upon a weighted average of GDP growth expectations in Motorola's three main geographic operating markets. Our 9.7% WACC, which incorporates recent interest rate increases, ESG considerations through an ESG adjusted beta, and major rate operating market adjustments, exceeds Motorola's current and historic estimated cost of capital. Our 258 estimate is most sensitive to increases in WACC and cost of goods sold. However, these risks are mitigated by our conservative equity risk premium and Motorola's gross profit margins, which are expected to continue expanding through their focus in software service acquisitions. The resulting upside beats S&P 500 analysts' 2022 expected returns.
To support our primary valuation, we additionally turn to different valuation techniques. Our first scenario analysis adjusts individual drivers to create bull and bear markets, producing a $321 and $190 target price, respectively. Our second scenario analysis, which randomly adjusts assumptions across 1 million Monte Carlo durations, produces a $263 implied valuation. And our third scenario analysis uses Brownian motion to simulate 1,252 trading day price path and yields a $260 target price. To confirm our FCFF model, we next discount its projected dividend stream across three considered scenarios, including a base case, which generates a $266 valuation. We then pair averages of key trading multiples of its three technology peer groups with Motorola forecast to estimate firm value, such as the EV to EBITDA suggested $258 target price. As a final validity check, factor analysis supports our projected upside with a forecasted 24.24% return, and risk-return metrics verify Motorola's superiority above its peers. While there are many factors that could impact our valuation, we're going to focus on the 5 most impactful ones. Looking first at inflation, in anticipation of potential future spikes, Motorola has tightened its contract-embedded CPI price escalators to more thoroughly counteract interest rate and margin impacts. Although pandemic-spurred global supply chain disruptions have dramatically increased backlogs, Motorola's DEI-motivated selection process creates a more flexible and geographically diverse supplier base. Additionally, its projected shift towards services decreases the impact of delivery exceptions. Acquisition integration could face headwinds, which delay revenue realization past the 2 years our model assumes. However, we expect Motorola to mitigate synergetic mishap impacts by continuing to monitor acquisition success and divest, if need be, as it has done in the recent past. Now, turning towards the political front, the valuation blow Motorola would incur if its effective tax rate rises to the Biden administration's proposed corporate tax rate may be lessened by leveraging foreign tax credits to partially offset domestic liabilities. And finally, Motorola's operations are heavily regulated, introducing compliance costs and decreasing competitiveness. However, its political action committee is very active, diversifies its risk by lobbying across the aisle. In conclusion, Motorola's economic mode, coupled with its strategic adjacency acquisitions in less protected technologies with favorable margins, are the 3 main factors that drive our buy recommendation. Now, we'd like to open the floor to your questions. Thank you.
Okay. We just saw on the last report that the company beat both on sales and earnings per share, and maintained the 2022 outlook. Do Do you think this is sustainable despite the supply chain constraints, or is this a threat for your valuation?
Absolutely. In terms of its sustainability, we agree with management that the earnings forecast for the full year is sustainable, specifically based on their strategic shift towards software and services, which is higher margin and less subject to those variable input costs. And Paula, if you want to talk about the supply chain as well.
Yes, absolutely. Thank you, Nolan. Obviously, management talked a lot about supply chain constraints and how they were successfully mitigating it, exploring those new substitutes, shifting to more towards services. They did mention that freight costs increased because they're trying to get parts faster through airplane delivery. And with the Ukraine invasion, those costs increased, but they have been successful in mitigating it by exploring those substitutes, increasing inventory, and those mitigating measures.
For the revenue projections, you mentioned the regression and certain sensitivities. May you please comment on those?
Absolutely. So, Nolan, within the financial analysis section within the main presentation. Thank you. So, how we derived top line growth was we used two parts. One was the statistical analyses across 50 or so factors taken from Statista, and we separated, well, we regressed them on both their products and systems revenues and software service revenues. And then we found which ones were statistically significant and used those as long as they had forecasted values to project future revenues. Additionally, we also have a 2-year implementation lag of any accretive revenues given by acquisitions that Motorola incurs within our model.
And if you're using this regression, how can you be sure that that these sensitivities stay the same for the next 10 years?
So we would only use the forecast for the next couple of years. Additionally, we only used statistics that had previous decades of data. So we looked to make sure that, for example, worldwide IT spending, global cybersecurity expenditures, it wasn't just from 2018 to 2021. We wanted to make sure that they had spanning years of data and that they were stable but still proved to be significant.
How do you justify the inclusion of the country risk premium in your equity risk premium?
Yeah, absolutely. So Nolan, if you can go within our cost of capital slide within the appendix. So looking at this, our country risk premium is 70 basis points, and that's to reflect a weighted average of sovereign debt differentials between revenue weighted the Motorola's three main geographic markets. That's Canada, United States, and the UK. That's how we derive the 70 basis points. And then the equity risk premium, which I mentioned was extra conservative, we added an additional 150 basis points compared to the Demoteran's 5% April estimate, as well as 50 basis points from the academic average of 6%, just for extra conservatism due to the unnecessary, like the and volatility with inflation, interest rates, geopolitical risks, and other unforeseen factors that could occur in the next 10 years.
Could you please elaborate on that profile and the impact of increase of rates on the following refinancing, please?
Absolutely. So, in terms of how Motorola finances its debt, it's all currently at a fixed rate. However, we do forecast that they will have to tap into their revolver in order to address liquidity issues relating to their large acquisition spending that we forecast. So, the interest rate risk would occur there if interest rates continue to rise. However, as you see on the left, Motorola has a large debt issuance due in 2024, ranging all the way to 2031, and those are all currently at fixed rates, alleviating that interest rate risk.
Is the acquisition of the UK-based company Calypsa a good move for Motorola Solutions? Why or why not?
Absolutely. In terms of looking at adding Calypsa to Motorola's current portfolio, it's really accretive for the company because the company is looking to shift many of its services to the cloud specifically. And Calypsa has expertise in moving video security and analytics to the cloud so that Motorola can provide those value added services for its existing video security and analytics customers.
Um, are the prices, the increased cost of semiconductors, freight costs, logistic costs, and whatnot, is there pricing in your fair value, and how?
Yes, absolutely. In terms of looking at our forecasted income statement, we adopted management's guidance on stagnation in gross profits year over year from 2021 to 2022, specifically related to those heightened semiconductor costs. However, because of Motorola's economic moat, it can it can push strategic price increases onto its customers to preserve gross margins year over year.
But it seems like your cost of sales is decreasing from what I'm looking at, and the expenses are also decreasing. That's what you're projecting.
Yeah, the initial outlook was through 2022 stagnation, and then after supply chain constraints are resolved, per management's guidance, looking at 2023, the supply chain constraints being solved largely, that's when their gross margin continues to a downward trend as it has done in the past, with its shift towards software and services.
What are your assumptions for the Monte Carlo analysis?
Absolutely. So, in terms of our assumptions for the Monte Carlo, we adjust key drivers simultaneously, such as cost of goods sold, SG&A, effective tax rate, days receivable, days payable, as well as our capital allocation, such as our acquisitions as a percentage of OCF, using historical averages and standard deviations over an 8-year period. So adjusting those key factors simultaneously to determine what our median target price would be.
You mentioned improved transparency in terms of ESG. Could you go further and just discuss the I would say the profile, ESG profile of the company?
Absolutely, great question. Nolan, if you could please take us within the main slide to our ESG overview. So one thing that Motorola does really well is their disclosure. They're actually performing better than any of their peers that we selected as their specific peers in the industries. We do mention in terms of energy, the renewable energy utilization, that's where they can improve. But in general, they have really good environment and social scores. In terms of governance, this is where we see the most improvement. We do have the CEO board chair appointment where Greg Brown, as the CEO, is also the board of directors chair, which does impose the agency problem of also having high compensation. But Nolan, if you could please go within our compensation slide. We do say one issue is that he has a relative excessive compensation. As we can see to the bottom left, the CEO pay ratio is fairly high compared to the other peers. However, in the top left, we see that a lot of it are stock awards, so performance-based compensation. And he has been doing a really good job in turning the company around and being a leader in the past 10 years, has been with Motorola for a very long time. So to the bottom right, as we can see, as the stock price increases, his compensation also increases. So therefore, we do not see it as that much of a risk.
Does the company set any targets for the environment concerns?
Yes. So one thing that they said they want to reduce, Nolan, within the slide, main slide deck, please, the overview. Reducing recycling rate or increasing recycling rates, so increasing recycling. And then their focus areas are what they said is GHG emissions. So they really aim at reducing those, and they have been doing this in the past. And then within environmental products and mineral sourcing, that is where their closed loop supply chain within the Congo comes in. So they are addressing diversity, equity, and inclusion also a lot within social focus. Data security, cybersecurity is very important. So they are really active in ESG and are a leader actually in ESG compared to the peer universe.
But did they set any specific year or number for the greenhouse
Numbers,
transfer?
which specific one are you referring to? For example,
GHG gas, for example, for emissions.
for emissions, and they want to get to, so for example, in terms of scope 1 and 2 emissions, they want to reduce it, and they actually already achieved this by 35%.
What are they doing in terms of waste reduction, specifically e-waste, since Motorola is producing a lot of those?
E-waste, and in terms of mineral sourcing, something that is really important for them is that they are, we do know that lamp or radio, their substances, they are regards to e-waste, but the closed loop supply chain is first of all very important, and then also high recycling rates and just making sure that they are responsible. And one thing that they also do, if we go to Nolan within the appendix, the MTech, please. Just in terms of, they have a committee from various different areas where they all come together and make sure that their products are ethically responsible in terms of their cybersecurity solutions, but then also in terms of environments and just in general, that they are in line with the ethics of the industry.
But like exactly what actions has been taken?
Well, one action that they are taking is they're going more away from land mobile radio to video security and analytic substances. So making this still a very important business of them, but focusing also on those cloud-based solutions more in depth.
Speaking of M&A, have there been any instances of integration risk, or do you foresee it in the future?
Yeah, absolutely. So Nolan, yeah, could you go to the acquisition integration risk within the main slide? So they have been very active, as you may recall, an acquisition timeline slide that we showed earlier with acquisitions specifically. Since our first valuation, they've incurred 4 new acquisitions, one being yesterday, actually. However, management is very good at making sure that they can monitor these acquisitions and divest. And as we can see here, from 2018 to today, they have made 3 divestments with TRX Systems, Agent, and Amanon.
Do you have a detailed EBITDA bridge, EBITDA, or to give more color on the margin evolution?
Are you asking in terms of EBITDA?
Yeah.
So in terms of the way that their EBITDA has been trending, we forecast that it returns to around 2019 levels by 2026. So that's a really conservative outlook, given their rapid shift towards software and services.
Time. Thank you.